Stablecoins move billions, but most people still don't know what they are. Let's fix that. Welcome to ValueBot Studios, and this is the first episode of our new series, ValueBot Explains. Every week, we break down the big ideas shaping money, tech, and investing in under 20 minutes. Today, we're unpacking stablecoins, what they are, why they matter, and how they're quietly reshaping the way money moves. Let's get into it.
Imagine transferring money across the globe in seconds for free and without needing a bank. That's not science fiction, that's stablecoins. But what exactly are they? Why do governments seem to fear them? And are they really stable? Today on The Deep Dive, our mission is to unpack these digital assets. We'll explore that fascinating tension between their really radical potential to reshape global finance and the equally powerful forces, traditional control, regulation, that are trying to rein them in.
Yeah, what's truly fascinating here is that we're looking at a financial innovation that doesn't just tweak traditional payment landscapes. It fundamentally reimagines them. But like you said, it also raises these incredibly important questions about stability, trust, and, well, who ultimately controls our money. It's a really rapidly evolving area where, technology, economics, and global policy all intersect. It makes for a complex but pretty compelling story.
Okay, let's unpack this for you then. For those who've heard the term stablecoin, maybe tossed around, what fundamentally separates them from something super volatile like Bitcoin? Or even just our everyday dollar? Why is that distinction so crucial here?
Yeah, that's the perfect place to start. So at their core, stablecoins are a special type of cryptocurrency. They're specifically engineered to, maintain a stable value. Unlike Bitcoin, right, which can swing wildly in price day to day, stablecoins aim to keep their price fixed, usually relative to a specific asset, like the US dollar. Sometimes it's commodities like gold or even other crypto assets. They achieve this stability through various mechanisms, mostly holding reserve assets or using quite sophisticated programmed algorithms.
Okay, so we've got this idea of a stable crypto, but I know there isn't just one flavor, right? I hear about fiat-backed, algorithmic, commodity-backed. How do these different kinds actually work, under the hood?
You're right. Yeah, there are several distinct types. Each has its own underlying mechanism for keeping that peg. The most prevalent are fiat-backed stablecoins. These currently account for, over 90% of the market. These are backed one-to-one by reserves held in traditional fiat currency like dollars or equivalent, highly liquid assets. Think short-term government bonds, big deposits. Big names like Tether, USDT, and USD Coin, USDC, those are the main ones.
Right, USDT and USDC, hear those all the time.
Exactly. Their primary appeal is really their design stability, and they're relatively simple to grasp, which makes them easier for regulators to understand. The trade-off, though, is that they involve centralized control. You're basically placing trust in the issuer to manage their reserves transparently and honestly.
And that trust factor is key, isn't it?
Absolutely crucial. Then we have cryptocurrency-backed stablecoins. Now, these are collateralized by other cryptocurrencies, often decentralized ones like Ethereum, to absorb the, inherent volatility of their underlying crypto assets. They are typically over-collateralized.
Over-collateralized. What does that mean in practice?
It means, for example, to mint, say, $1 of DAI, that's a well-known crypto-backed stablecoin. You might need to lock up $1.70 worth of Ethereum. This over-collateralization is vital. It creates a buffer, right? It allows the underlying crypto to swing in value, maybe 30%, without immediately destabilizing the stablecoin. It's like a safety net. They operate more through automated digital contracts, smart contracts.
Smart contracts, yeah, we hear that term a lot in crypto. Can you just quickly explain what they are in this context? Why are they important for, decentralization here?
Good question. Smart contracts are essentially self-executing agreements. The terms are written directly into code on a blockchain. Think of them like automated digital vending machines for finance. They run exactly as programmed, no need for a third party to enforce them. In the case of crypto-backed stablecoins, these smart contracts automatically handle minting, burning tokens, managing the collateral. It enhances transparency and cuts out intermediaries. That's key for decentralization.
Okay, that makes sense. Automated trust, kind of.
Yeah.
What else is there?
All right. Next up are commodity-backed stablecoins. These are pretty straightforward. They're backed by physical assets, most commonly gold. PayX Gold, Tether Gold are examples. And naturally, their value fluctuates directly with the price of gold or whatever commodity they represent.
So not stable against the dollar necessarily, but stable against gold.
Precisely. Finally, we get to algorithmic stablecoins. Now, these are arguably the most innovative, But they also carry the highest risk. They attempt to maintain their value automatically through program mechanisms, smart contracts, economic incentives that dynamically adjust supply and demand, and crucially, without direct collateral or sometimes only partial collateral.
How does that even work, adjusting supply and demand automatically?
Well, if the stablecoin's price dips below its peg, say 39-day, the system might incentivize users to burn or permanently destroy tokens. This reduces supply and, theoretically, pushes the price back up to $1. Conversely, if it goes above $1, it might encourage minting new tokens to increase supply and bring it down. It's supposed to be this automated balancing act. But as we saw with the infamous collapse of Terra USD or UST back in 2022,
Oh yeah, that was huge.
it was brutal. It demonstrated just how incredibly fragile this mechanism can be if confidence is lost. It can lead to a death spiral. The European Central Bank, for instance, now basically considers these unbacked crypto assets because of that inherent volatility.
Wow. So quite a range of approaches, each with its own, let's say, quirks. But stepping back a bit, beyond just being a stable crypto, what fundamental problem were stablecoins actually created to solve? Why are they so appealing? And maybe more importantly, why should you, listening now, actually care about them?
Yeah, that's where the real insight lies, I think. You see, the original vision for Bitcoin, way back in 2009, was actually a peer-to-peer electronic cash system. But its extreme price swings, as we discussed, quickly made it pretty unusable for everyday payments. I mean, imagine trying to buy coffee with Bitcoin.
And the price drops 10% before your latte is even ready.
Exactly. So stablecoins emerged around 2014 specifically to solve this volatility issue. They offered crypto investors a kind of safe haven to park funds without constantly converting back to traditional fiat. It's like having a stable harbor in the, stormy seas of crypto trading.
Okay, a safe haven for traders, but you mentioned more.
Oh yeah, the story definitely doesn't end there. It actually becomes far more significant for, anyone who moves money, especially globally. Stablecoins are truly revolutionizing payments, particularly cross-border transactions. Think about the current system for a second. Traditional international payments, they can take anywhere from 3 to 7 days to clear.
Days. Yeah, it's painfully slow.
And astonishingly, they can cost up to 10% in fees because you've got multiple intermediaries, banks, payment processors, card networks like Visa or MasterCard, Swift. It's just an incredibly inefficient, almost archaic system in the digital age. Stablecoins, on the other hand, offer this transformative efficiency. A transaction, any amount, can settle for less than a penny in cost.
Less than a penny. Seriously.
Seriously, and typically under a second. It's not just like a small improvement. It's a complete paradigm shift in how digital money can flow globally.
That is a staggering difference. I mean, night and day. Yeah. So how might these new payment rails actually affect, say, someone trying to send money home across borders, or maybe a gig worker waiting for payment? What's the practical impact for them?
It means stablecoins are bridging really significant financial gaps globally. They offer solutions to very real-world problems. For instance, they allow millions of gig workers around the world to get paid faster and much more cheaply. They can bypass traditional banking challenges, which are often quite pronounced in their regions. I've personally heard so many stories from gig workers, say in the Philippines, who used to wait weeks for payment, losing a huge chunk to fees. Now they see it settle in minutes, literally for pennies. It's truly transformative for their livelihoods.
Wow, that's a powerful use case.
Definitely. And they also serve as a crucial hedge against hyperinflation in places like Pakistan, Argentina, Turkey, where the local currency can feel like it's going only down, as someone put it.
Yeah.
Stablecoins provide exposure to stable currencies, usually the US dollar. And they often trade at a premium there because of that stability. It's a lifeline for just preserving purchasing power.
So a way to access dollars digitally when local currency is unstable.
Exactly. And it's not just individuals anymore. Institutional use cases are rapidly growing. Fintech companies like Stripe, Revolut, Robinhood, and even huge corporations like SpaceX are reportedly using stablecoins for treasury management, for business-to-business settlements. They're ripping out those inefficient backends from their financial operations. They really act as this liquidity bridge, between traditional finance and the evolving blockchain world. Makes it easier for large sums of money to move efficiently between these two ecosystems.
Okay, and what about the tech itself? Is it ready for prime time?
The infrastructure is maturing tremendously. We're seeing huge advances in blockchain scaling platforms like Solana or Ethereum Layer 2s. These Layer 2s are like, think of them as express lanes built on top of the main blockchain highway. They drastically improve transaction speed and lower cost by processing lots of transactions off-chain before settling them back on the main network. makes stablecoin transfers way more efficient and affordable. Wallet technology, too, from consumer-friendly ones like MetaMask and Phantom to really robust institutional-grade solutions, it's all getting more user-friendly and secure. Plus, you have on-chain analytics companies providing real-time monitoring and anti-money laundering tools. That makes the whole ecosystem safer.
This all paints a really powerful picture of efficiency and access, and it leads us to a fascinating intersection you touched on, AI and crypto. How do stablecoins fit into that emerging future, especially when we think about AI agents transacting on our behalf?
Yeah, that's a truly cutting-edge application. Yeah, I mean, imagine AI agents needing to transact seamlessly efficiently without any human intervention. Stablecoins could become the sort of fundamental stable currency for these decentralized AI economies. You could potentially give an AI agent your crypto wallet to transact for up of it, maybe paying for decentralized compute marketplaces for AI workloads, or even new business models for internet content where contributors get instantly compensated via crypto. That's a capability that just isn't possible with a traditional bank account or credit card today. It opens up entirely new models for how we interact with money digitally in an increasingly automated world.
Okay, so we've highlighted the incredible upsides, right? The deep problems stablecoins seem to solve. But as with any powerful innovation, there has to be a flip side. What are the major risks? The hidden vulnerabilities may be lurking beneath the surface that you, the listeners, should really be aware of.
You're absolutely right to ask that, because despite their name, stablecoins are not necessarily stable. That's key. We've seen de-pegging incidents where they temporarily lose their one-to-one value. For example, USDC briefly lost its peg during the Silicon Valley Bank crisis, part of that crypto asset winter of 2022-23, and of course the dramatic collapse of the algorithmic stablecoin tier USD/UST in 2022. That's a really stark reminder of their inherent volatility and the potential for a death spiral, where a loss of confidence triggers a rapid, irreversible collapse.
Right, the death spiral. That sounds terrifying.
It is. And for fiat-backed stablecoins, there's also what's called counterparty risk. Basically, you're trusting the issuer, the company behind the coin, to honestly manage their reserves. While Tether, for instance, cites audits now, there's been historical scrutiny over their reserve backing. You're effectively relying on the issuer's integrity and transparency. Algorithmic stablecoins, as we discussed, rely solely on code, so they're also prone to smart contract errors, hacks, and that dreaded death spiral if new users stop providing collateral. Some critics have even likened certain models to Ponzi schemes because they rely on continuous new investment just to maintain the peg.
Okay, so market stability is one thing, but what about the bigger picture? How do governments, regulators globally, how do they view these things? It sounds like there's a lot of friction there.
There absolutely is, and it brings us to some pretty significant regulatory and societal concerns. Stablecoins' global accessibility, unfortunately, also makes them attractive for illicit activities. They have been exploited by high-risk and illicit actors, as reports say, for things like pig butchering, scams those sophisticated romance or investment frauds. Tether's USDT has often been cited as a preferred choice for criminals in these cases, which led to, for example, the U.S. Department of Justice seizing $225 million linked to such scams in June 2025.
Wow, $225 million. So law enforcement is catching up.
They are. And it's important to note, the issuers themselves are actively working with law enforcement. They have mechanisms to freeze funds on suspect addresses, and even burn tokens, permanently take them out of circulation, linked to confirmed criminal activity. Another concern, though, is centralized control. Despite running on decentralized blockchains, the central entities issuing fiat-backed stablecoins like Tether or Circle, they can freeze funds on specific addresses if compelled by law enforcement. This has happened, and it's definitely a point of tension for people who prioritize absolute decentralization and censorship resistance.
Right, the control aspect. What about governments worrying about their own currencies?
That's the huge issue of monetary sovereignty and capital control. Countries like China, for instance, definitely fear stablecoins could lead to capital outflows, undermining their tight control over the financial system, even as they push their own digital yuan. Policymakers in the U.S., on the other hand, sometimes openly state that dollar-backed tokens can actually cement U.S. dominance in global finance. It becomes a geopolitical tool almost. But as Rebecca Liao of Saga put it quite well, this is not technology that can be centrally controlled. When governments invest in this technology, it will be taken to places that they do not like. It really highlights that fundamental struggle between disruptive innovation and traditional state control.
It sounds like a real tug of war. And what about the Bank of England's concern? You mentioned the singleness of money. That sounds quite fundamental. What do they mean?
It is fundamental. The Bank of England emphasizes what they call the singleness of money. It's the principle that all forms of money, cash, bank deposits, potentially well-regulated stablecoins should have the same value, be universally accepted, and be interchangeable without any loss. Think about it. Your dollar bill is always worth $1 everywhere. You can freely exchange it for digital dollars in your bank account, one for one. Regulators worry that if loads of different stablecoins proliferate and maybe they behave differently, or if public confidence in traditional money starts to waver, we could lose that fundamental trust and interchangeability that underpins our whole financial system. And a key difference for you, the consumer, to really note, stablecoins generally do not offer government-backed deposit insurance like traditional bank accounts do. That's a critical difference in consumer protection.
No safety net like FDIC insurance. Got it. Okay, so given all these incredible benefits, but also these really significant risks and regulatory battles, what does the road ahead look like for stablecoins? Will they truly become mainstream? And what will that mean for how we all interact with money?
Well, the future seems to be one of rapid evolution and, crucially, increasing integration. And this is largely being driven by global regulatory efforts finally catching up. We're seeing a huge push for regulatory clarity and harmonization across major economies. In the U.S., there's the Bipartisan Genius Act, signed into law July 18, 2025, that provides a federal licensing framework. And it explicitly requires stablecoins to be backed 1.1 in value by a trustworthy fiat or commodity asset. Though, it's worth noting, groups like Consumer Reports criticized it, saying it didn't go far enough on consumer protection.
Okay, so the U.S. has a framework now. What about Europe?
Europe is actually ahead in some ways with its MiCA framework that's markets and crypto assets regulation. It started taking effect for stablecoins in June 2024. MiCA imposes really strict rules on governance, reserves, redemption rights. These rules are so stringent, in fact, that those purely algorithmic stablecoins we talked about, highly unlikely they'll meet MiCA standards. The UK is also moving fast with its Financial Services and Markets Act 2023. The Bank of England is focusing on sterling-denominated systemic stablecoins, and they're proposing they be backed by 100% central bank deposits, which is a pretty unique and conservative stance. They're also suggesting issuers should not receive interest on their central bank deposits or pay interest to coin holders. The goal there is to push them towards being used for payments, not as investment vehicles. They're even considering holding limits, maybe £10,000 or £20,000 per person, to mitigate risks of people suddenly pulling lots of money out of traditional banks during a transition period.
Wow, holding limits. That's interesting. And Asia?
Asia's active too. Hong Kong passed its stablecoins bill in May 2025, expecting first licenses in early 2026. Singapore finalized its framework. Japan already has one in place. So global harmonization of rules, that's really a key prediction for this year, 2025.
That's a massive amount of regulatory movement happening almost simultaneously. What about the market itself? Is this still niche tech, or are we really seeing mass adoption kick in?
The market growth has been absolutely phenomenal, definitely far from niche now. The total stablecoin market cap, it soared from about $20 billion in 2020 to $246 billion by May 2025. That's a 1,200% surge. And get this, $28 trillion in transfer volume last year alone, that actually surpassed both Visa and MasterCard combined.
28 trillion, surpassing Visa and MasterCard.
Yep. The scale is already immense. And forecasts suggest it could reach $2 trillion market cap by 2028. We also anticipate non-USD stablecoins, Euro, British pound stablecoins gaining significant ground as this new regulation unlocks their potential outside the US. Some experts genuinely believe the odds are good that stablecoins are that thing. The killer app that will truly bring hundreds of millions, maybe billions of users into the crypto world by solving those very real pain points we discussed, like cross-border payments, inflation hedges.
So huge growth, but also disruption.
Absolutely. Significant competition and disruption for traditional finance. You've got central bank digital currencies, CBDCs, things like a potential digital pound, or China's ECNY being explored as government-backed competitors. Crypto itself is, well, fundamentally radical, as some put it. It's inherently disruptive for traditional players. That's partly why big tech companies like Google or Facebook really struggled with their own stablecoin initiatives like Libra Diem. The regulatory hurdles were immense. However, now you see many incumbents, Visa, MasterCard, major U.S. banks, Stripe, they're actively exploring or even integrating stablecoins into their systems. They realize they probably can't afford to ignore this innovation any longer.
Fascinating. Okay, so wrapping this up, what does this all mean for you listening right now? We've taken a really deep dive into stablecoins, this fascinating innovation that seems poised to change how we think about money and payments.
Yet, if we connect this all back to the bigger picture, Stablecoins clearly offer incredible potential for efficiency and accessibility. But they also bring these critical questions of trust, control, and regulation right into sharp focus. The principal regulators are aiming for is same risk, same regulatory outcome. Treat stablecoins with similar functions to existing financial products similarly. But it's a really complex path to get there, right? Requires carefully navigating brand new technologies alongside deeply established financial systems. It really is a testament to that ongoing tension between innovation and the need for stability and control.
So from global remittances becoming instant and nearly free to maybe AI agents transacting on your behalf in the future, stablecoins are clearly no longer just some crypto curiosity. They represent a fundamental potential shift in how digital money flows through the entire global financial system. The provocative thought for you is, how will your financial life be transformed as this space continues its rapid evolution? Thanks for diving deep with us today. We'll catch you next time.
That's it for this episode of ValueBot Explains. If you found this helpful, share it with a friend or hit follow. There's a lot more coming. Thanks for listening. See you next time. Goodbye.